In today's show, we're opening up the listener mailbag to answer questions about distributions that you might need to take from an inheritance, combining old 401ks into an IRA, and then how to invest for inflation, and then also how to invest if you're within 5 years of retirement. You might find yourself in the same or similar situations as those asking the questions today and have a lot of great strategies to take away and implement in your situation.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Retirement Show, all about your life, your money, and your taxes. I'm your host, Scott Searins, and my goal is to help you thrive in life, wealth, and retirement. Thanks for joining us today. Last episode of this month, and what I thought we'd do is open up the mailbag again. So if you do have a question that you'd like for us to answer in the podcast, feel free to go to lifemoneyshow.com. Again, that's lifemoneyshow.com. Click on the show notes or this episode. You'll find in that section, like on the right-hand side, it'll have an area where you can enter in a question to ask us, and we'd be happy to answer it on air. What we're starting to do is the last episode of each month is opening up the mailbag, answering your questions. So hopefully you'll find today very helpful. It's a great time to learn from each other. You might find yourself in the same or in a similar situation, or if you're just listening in, there's always a lot of great strategies that you can learn from other people's questions and then implement into your own situation. So I'm sure you're going to find today really helpful. We're going to talk about required distributions from inheritance, combining old 401ks into an IRA, investing for inflation specifically, and then also how to invest for retirement. Maybe you are more aggressive, your spouse is more conservative, and how does all of that fit in? Now, before we get to all those questions, if you haven't yet, I highly recommend sign up for our insiders list. You can go to lifemoneyshow.com, you scroll down, and there's an area there where you can sign up for our insiders list. What it is it's our weekly email. You're going to get weekly emails regarding retirement tips, tax reduction strategies, all great information to help you understand if you're on that right path to retirement, understand how to retire with confidence, understand how to keep more of your hard-earned money in your pocket versus giving it to the IRS. Our latest wealth report was 3 tax planning strategies to deploy year-round. I think people found that really helpful. We've also had wealth reports on tips regarding Social Securities, plus many more. So lifemoneyshow.com, you scroll down and you can sign up there for our insiders list. Hopefully you find it just as helpful as everyone else. Okay, with that, let's dive into the questions from this week's listener mailbag. We've got 4 different questions. The first question is from Alexander. Alexander says, how should I be investing if my biggest concern for the next few years is all of this inflation? Well, first off, as you know, I like to break the questions down. Just because Alexander understands inflation doesn't mean everybody necessarily does. So what is inflation? Inflation is the cost of goods and services going up over time. Now, as Alexander said in his question, his biggest concern for the next few years is inflation. Well, Alexander, I just want to kind of use your question here to educate or inform us all, is that inflation's not going to be just a few-year problem. It's not a 1-year problem. It's not a 2-year problem. It's not a few-year problem. This is actually, we'll call it, since we're now calling it a problem, we're going to call it a life problem or a life issue that we need to overcome. Just looking at the JP Morgan guide to the markets, and I'm going to give you some statistics today in this question, and I'm going to link all of the sources in the show notes. So you can go to lifemoneyshow.com, click on the show notes. We're going to have all of the links there from the JP Morgan Guide to the Markets, Investopedia, as well as others. So here we go. So headline CPI. Now that's the Consumer Price Index, which measures the cost of goods and services and if they're going up over time. So just to give some examples of why Alexander is concerned, in October of 2022, Headline CPI, basically the consumer price index, grew by 7.8%. November of 2022, 7.1%. So that means cost of goods and services year over year going up 7.8%, 7.1%. That's a lot, right? I mean, that is a lot when it comes to your groceries. That's a lot when it comes to the services that you're hiring, your utilities. Now, just because we're seeing that right now, remember, don't let short-term statistic fog what that long-term potential might be. Now, yes, and Alexander's right, we should be, not to say concerned, but we should understand that inflation will be part of life. So in that same article that I'll link to, it shows that the 50-year, and again, the 50-year average when it comes to inflation, the 50-year average, headline CPI, is 4%. So recently, right, we're seeing 7.8, 7.1, but the 50-year average is not that high. It's actually 4%. So just that's hopefully an overall in regards to inflation, and that, yes, we're going to see it not just for 1 or 2 years. We're going to see it every year for the rest of our lives. And now to answer Alexander's question, how should we be investing? Well, the short answer is you need to be in equities. You need to have equities in your portfolio as an investment, because that investment, based on history, will outpace inflation. And I know what you're thinking. Well, wait a second. Right now, the market is down. I should be in equities. Last year, it fell over 15%. At some points in time last year, it was down over 20%. And I understand, and again, not letting short-term thinking fog those long-term potential results. You see, because if we look at the S&P 500, and again, you can't invest directly into the S&P 500, but that's the 500 largest stocks in the U.S. How did the S&P 500 perform from 1957 to the end of last year? Now, that's 65 years. And over those 65 years, the average return was 10.15%, according to Investopedia. Again, we'll link to that in the show notes. So we should be putting ourselves in investments that are going to outpace inflation. And if we look at that, that's almost, and again, looking at the 50-year average of inflation of 4%, we're putting ourselves in something that will outpace inflation potentially by over double. And I know what you're thinking. Well, wait a second. There's also bonds and bond funds out there. And bond funds will help you potentially keep pace with inflation. Now, the average return of bond funds are somewhere between 4 to 6%. You know, you look at most recent results, interest rates have been very low. Bond funds weren't producing that much. Of course, last year was a horrific year for bond funds as they were down over 15% themselves. Either way, they were negative last year. And so, again, don't let the short-term fog that long-term results for bond funds, again, somewhere in that 4 to 6% range, at which point then you're just keeping pace and at some points potentially underperforming inflation. So you kind of have to ask yourself, hey, how should you be investing if you're concerned for inflation? I would be putting equities in your portfolio, as you will need an investment that's outpacing inflation. So hopefully that helps. One, just give everybody a little insight to your question about inflation, but two, also helps people understand what types of investments will help them outpace inflation. And it's important to have, that's why it's important even in retirement, right? Because you have to think, a lot of times in retirement, people go, oh, I'm going to move conservative. I'm in retirement. I need to be conservative. However, retirement might last 10 years, might last 20 years, might last 30 years, or if you're retiring in your 50s, it could last 40 years. 40 years of inflation, you definitely need, well, I'm not going to say definitely, everybody's situation is unique and different, but I'd highly recommend that you have investments in your portfolio that are going to outpace inflation. I find sometimes people get too conservative, but the equity part of your portfolio is a necessary part of your portfolio. Be careful in regards to going too conservative, because you might not have enough money then growing to spend in your future and to outpace inflation. So hopefully, Alexander, that helped your question. And actually, it's going to kind of lead into our next question from Lucas. Lucas says, I'm not retiring for another 5 years, so I don't feel the need to be ultra conservative with my money. Just what I was talking about. Sometimes people get too conservative. But my wife keeps insisting that she wants me to be more secure. Just how secure do I need to be at this stage in my life? Well, Lucas is on the side of equities, right? He's saying, hey, I don't want to be ultra conservative. And to the point that we've talked about earlier, you need growth because you need to keep up with inflation. However, Lucas is entering or is now in what I'd like to call the hazard zone. Kind of that time period where you're within 10 years before retirement, 10 years after retirement. And specifically, especially when you kind of get into the 5-year zone prior to and after retirement. Now, why do I call this the hazard zone? Well, it's kind of like driving into a construction zone. What do we do when we drive into a construction zone? 1, we have to think differently. 2, slow down. And 3, be prepared for the unexpected. So how does this relate to retirement? How does this relate to life as we're entering retirement, as we're 5 years away? Because we're still not there yet, right? Well, we have to first off think differently. Our retirement savings, everything that we've saved up right now, Lucas, it sounds like, has a company paycheck coming in. And Lucas, at some point in time, that company paycheck is no longer going to come in. And at that point in time, you're then going to have to shift over to your retirement savings to start cutting your own retirement paychecks. And that's a lot different of a mindset. You see, right now you're in the saver's mindset. You're taking money in, you've got your company paycheck coming in, some might be going into your 401k or your Roth IRA, and you're in that saver's mindset. But since you're within 5 years, you already have to start thinking about that money that you've been saving up. You now are going to need to utilize that to create your own retirement paychecks. So Lucas, to your wife's point, you might want to start thinking differently about your money. Start looking at the retirement savings that you've saved up as the new company that's going to start cutting you retirement paychecks once you hit retirement in 5 years. So I'm assuming it's really important that you want to take care of this company to make sure your money's there so it can cut you those retirement paychecks. Okay, that was think differently. Number 2, slow down. As we enter into a construction zone, it's important that we slow down. So that way we can properly get through the construction zone for our safety and for the safety of those around us. Well, same thing as we get closer to retirement. Slow down means that we want to start reducing risk. Now, I didn't say get ultra conservative, and we're going to talk about this in a little bit here, but we want to start reducing risk. We want to start taking care of that new company that's going to start cutting us retirement paychecks when we retire. And the third thing is be prepared for the unexpected. I wish I had the crystal ball for you, Lucas. I think everybody wishes they had the crystal ball to tell us what's going to happen in the market tomorrow. But we don't know. We have no idea. Anybody could tell you. You could read articles all day long, and at the end of the day, nobody knows what's going to happen in the stock market tomorrow. Now, we do know, and we have seen what happens over the long term, but we don't know what's going to happen tomorrow. We don't know what's going to happen in the short term, and so we have to be prepared for the unexpected. We have to be prepared for volatility. We've got to be prepared for the ups and the downs in the market, and we have to be prepared in the event of a big market drop. So that's the last part, is having your portfolio prepared for the unexpected. So you want to start aligning your portfolio, Lucas, so that it can support you, right? That new company, right, your retirement company now, can cut you paychecks in a good economy or in a poor economy. And there's really 2 parts to thinking through this. And I'm getting to the answer of your question here, like how secure do you need to be at this stage? So let's answer that part of your question. Now, there's 2 parts to that. One is understanding how much income you're going to need in retirement. And then the other part is, if the market were to go through a major downturn, let's say like 2008, how long do you think it's going to take the market to recover from the decline? So let's walk through an example. Say you have a portfolio that can produce $50,000 a year in income, and you're going to need all of that $50,000 a year in income. And you also feel like, okay, hey, worst case scenario, the market corrects. It's going to take 5 years for it to recover. And let's say now 1 year has passed by, so you're going to retire in 4 years. So what does this tell me? Well, it tells me that you have 4 years working. So you have 4 years. So if we think that the market's going to take 5 years to recover, you've got 4 years of that 5-year recovery that you're going to be working. Great. We've got 4 years to watch it, 4 out of the 5 years covered of watching it bounce back. However, we have 1 year that's not covered. 1 year then where, wait a second, we're not covered on that bounce back with your current company paycheck. And so then my recommendation is then we shift 1 year's worth of income, right? $50,000 that you're going to need in the future. We start to shift that 1 year's worth of income over into the safer side of your portfolio. So sounds like you'd like to be aggressive. Your life likes to be ultra conservative. But instead, what if you put a strategy to it and you start to shift that 1 year over to the safer side of your portfolio? Now we've got $50,000 in the safer side of the portfolio. And then wait a second, now you're 3 years from retirement. Well, we got 3 years of income to get through any sort of market recovery, but we have 2 years that aren't covered. So what do we need? Now we need 2 years, or we need $100,000 in that safer side of your portfolio. And then, as you can see, as you get closer and closer, you continue to shift money over to the safer side of your portfolio. So that way, when you're retired, you've got 5 years worth of your income needs over there on the safer side of your portfolio. Now, everybody is unique. Everybody is different. I've had people sit at our conference room table here and say, Scott, that sounds great, except for I don't think it's going to take 5 years to recover. I think it's going to take 3 years. So I want to have 3 years on the safer side of our portfolio. I've had some people say, you know what, that's great, except for from an emotional standpoint, I still just can't handle the volatility. And if I can't take as much income, that's okay. But I'd rather have 7 years, or I'd rather have 10 years on the safer side of my portfolio. Now, again, they'll have less money keeping up with inflation because they'll have less money on the growth side. They'll have less money growing for them, so potentially less income coming in. But that's the other part, right, is being able to sleep at night. So I like to put a strategy to the money, Lucas, versus just using these words, which are very subjective, of being aggressive or being ultra conservative. All those words are so subjective that they really don't have meaning of anything when it comes to your portfolio. So hopefully this helped you and your spouse kind of find that balance, or gives you a strategy for the two of you to be able to find that balance of, hey, how much should we have on the growth side? How much should we have on the safer side of our portfolio? And then continue to monitor and adjust that each and every year based on the income that you'll need coming in. Lucas, great question. I hope that it helped you. And I know that's such a question that there are so many people out there within 3, 4, 5, 1 year of retirement. And so I really hope that that question helped a lot of people out. All right, our third question of the day is from Ruth. Ruth said, I was told recently that I should combine all of my old 401ks into just one rollover IRA. But that seems to contrast to the idea of diversification. What am I missing? Oh boy, great question here, Ruth. Thanks for sending this one in, because this is a question that I think I hear a lot, and I'm guessing there's a lot of people out there in the same shoes as you. And let me guess, Ruth. Now let's go back to what Ruth was asking here and just break it down. She's got a lot of old 401ks. She's been told to just roll them into one IRA. So Ruth has multiple accounts, and she's been told, hey, I should put them into one IRA, a rollover non-taxable event. But she's like, wait a second, I thought I should be diversified. And so let me guess, Ruth, you've heard this saying that you don't want all of your eggs in one basket. Let's just think about what the basket actually is in this saying. We don't want all of our eggs being our money, right? We don't want all of our eggs in one basket. But what is actually the basket in this saying, and how does it relate to investments? So is the basket where your money is, I'll call it stored, where your money is held? So is the basket the institution where your money is held, or is the basket that you don't want all of your money in the same stock? You don't want all of your money in Apple. You don't want all of your money in Facebook. You don't want all of your money in Home Depot. I'm guessing the actual answer here, and as the actual answer should be, is you don't want all of your money in the same stock. We don't want all of our money sitting in Apple, or we don't want all of our money sitting in Amazon or Home Depot or Lowe's, because what happens if something happens to that one stock? And so I'll just share a quick story with you to help finalize the answer here, because I find that a lot of people get confused about what the basket is. We don't want all of our eggs in one basket, but what is actually the basket? And the basket in this case is we don't want all of our eggs in the same stock. So just to give you a quick story here of a new client that we recently met with, as they came in to go through our retirement process, as we went through and we looked at all of their different initial holdings, where they were at today, they came in just kind of the same mindset as yourself, Ruth, is that they had money in old 401ks, different locations. I think they had their money in probably 4 different locations. Now, once we reviewed the actual holdings at these locations, so the mutual funds, the exchange-traded funds, the funds that they held in all of these different locations, guess what? All 4 locations had multiple holdings that all had the same stock. So why they thought their eggs were in different baskets, because they were considering the baskets different custodians, locations where the money was stored. Instead, they actually had a lot of their money in the same basket, because even though they were at these different locations, they were at Vanguard, and they were at Fidelity, and they were at TD Ameritrade, and they were at Schwab. They had all like different locations like that. Those different locations all had funds, and then the funds in those locations were all holding positions, guess what, in the same stock. And next thing you know, they had even at 5 different locations, right, or 4, whatever it was, they had multiple funds in those locations. So next thing you know, they had 10 funds all holding the same position in Apple. And so because of that, their position in Apple became much higher than it should have been, and putting them at more risk than where they should have been. So what is the ending to this story? Well, what we did is we rolled them over to one location, one custodian, but then we diversified them at that one custodian, that one location, into different baskets. And the baskets this time being different funds, and those funds holding different stocks. So hopefully this helped you in regards to your answer. Yes, in my opinion, it is okay to roll over to one location, but at that one location, that then is when you want to be diversified. You want to have funds that diversify you, so you have some of your money in equities, maybe some of your money in bond funds, and some of your money in international equities. Then within that, you want to be further diversified in your funds, that you've got so much money in large cap, so much money in mid cap, so much money in small cap, and same thing throughout your bond funds. You want corporate, you want high yielding, you want mortgage backed, you want treasuries. And so that's diversification. That's where you want to have your eggs in different baskets. But as far as where the money sits, you want to just have a trusted location where the money sits. Once it's there, use different baskets to put the money in. So, Ruth, hopefully that helped you out. A lot of people sit down in our initial meetings and they've heard that statement just like you, and they thought having their money in 5 different locations was diversifying them. And then once we go through and we look at our stock intersection report, we see that at all 5 of those locations, they're actually holding the same funds or the same stock, and they're actually more risky than what they originally thought. So hopefully that helps you out. Hopefully those were some good analogies to help see that next step of putting all of your money in one location is okay, as long as the advisor that you're working with or the financial professionals that you're working with are diversifying you at that location. Okay, Question number 4, our final question of the day, is from Michael. Michael said, I inherited some money from my mom when she passed away last year, and I just got a letter telling me that I have to withdraw some money from the account this year. What's that all about? I thought that I didn't have to do that until I was in my 70s. Well, Michael, I'm assuming here that what you inherited from your mother was an IRA account, and inherited IRAs do require what they call our required minimum distributions, or sometimes you'll hear them called RMDs. And it is a required distribution. And in essence, what's happened is that when your mother put money into these IRA accounts, she did not pay tax on the money. Don't worry, she didn't do anything wrong. It's actually part of putting money into an IRA. You get a tax deduction for the year that you put the money in. And essentially what you're doing is you're kicking the tax bucket down the road. You're kicking the tax man request down the road. And so when your mother passed away and when that money came over to you, the government, the IRS, still wants to collect their fair share of taxes on that money. And so the IRS has passed rules that says, yes, even if you inherit an IRA, you, the inheritor, will still have to take required distributions, meaning forced income that you have to take out of that account, so that way the IRS can get their fair share and cut of taxes. Now, there's rules that were recently passed, so depending on when your mother passed away, I believe if it was before the end of 2019, then you can stretch those required minimum distributions over your lifetime. If it was after that, then yes, you still have to take out money each and every year, but then you have to take it all out over 10 years. And so, talk to your financial professional. If you don't have one, feel free, give us a call. We can help you out in regards to that as well. You go to lifemoneyshow.com, click on the Work With Us tab. But either way, yes, you will need to take those required distributions. One is either stretching it over your lifetime or taking them out every year, but you have to make sure they all come out over 10 years. And that's all based upon when your mother passed away. So the letter that you got in the mail is most likely correct, and you just want to talk with that institution to understand fully how much you need to take out. And then again, can you do it over your lifetime, or do you need to, or can you do it over 10 years? Hey, hopefully you found that helpful. I think today there's a lot of strategies that actually would apply to lots of people at different stages in their lives or in their preparation for retirement. So hopefully you found that to be of value and benefit. If so, subscribe to the podcast and make sure that you're getting notified as we're continuing to come out with new episodes each and every week. As I mentioned from at the beginning of the show, if you haven't yet, sign up for our insiders list. Go to lifemoneyshow.com. You scroll down, sign up for the insiders list. And what that is, again, is our weekly email. It's going to provide you retirement tips, tax reduction strategies, Social Security strategies, and much, much more to help you understand if you're on that right path to retirement, help you understand how to retire with confidence, help you understand how to enjoy your money today, how much you can spend today, but also make that money last through your retirement. Our latest wealth report was all about taxes, 3 tax planning strategies to deploy in your situation year-round. So as you know, I'm not a big fan of taxes. We want to pay what we legally have to, but not leave the IRS a tip. So again, thanks for joining me. I look forward to our next conversation, to helping you enjoy life today while being financially confident about your tomorrow.
Investment advisory products and services made available through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM and Searns Financial Group, Inc. are not affiliated companies. Insurance products are offered through the insurance business Searns Financial Management, Inc. Searns Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Searns Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Searns Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc. Bond obligations are subject to the financial strength of the bond issuer and its ability to pay. Before investing, consult your financial advisor to understand the risks involved with purchasing bonds.